Hey guys, it's Aman from Our Rich Journey, and we must talk about what has taken place in the stock market this week when it comes to the technology sector. You see, this week was the quarterly earnings report for the top 5 tech companies on the stock market. We had Microsoft, Apple, Amazon, Alphabet, and Meta all report earnings this week. And if you were watching the stocks of these companies, you saw a lot of volatility. But what was so interesting was not what was happening with the stock values, but what the companies were saying about their overall business. You see, a lot is going on right now in the world, and it is coming out in the stock market, especially in these tech stocks. And we can learn a lot about the overall economy and the future of the stock market by paying attention to what these companies talked about this week on their quarterly earnings reports. And for the investors that want to invest in these companies to build wealth for financial independence, there were some things said that I think you can be optimistic about, but there are also some things that you should be cautious about if you are planning to invest in these companies. So let's first start this discussion by very quickly going over the quarterly reports for all 5 of these companies and hitting on some of the highlights and lowlights. Let's start off with Amazon. Amazon reported $127.10 billion in revenue, but analysts forecasted $127.46 billion. And because Amazon did not meet expectations, its stock dropped significantly. In fact, it got as low as about 15% after it reported its earnings. Now, something to keep in mind is that even though Amazon had lower than expected revenue, its revenue still grew by 15% year over year. But Amazon's stock price has been doing terrible over the past 52 weeks. In fact, the stock price is down almost 45% from its 52-week high. The next stock to talk about is Apple. Apple generated over $90 billion in revenue in the third quarter, which beat Wall Street's expectations. And because of this, Apple's stock price generally did good when it reported its earnings. But still, Apple stock is still down about 15% from its 52-week high. Next, let's talk about Alphabet. Alphabet reported revenue of about $69 billion, but Wall Street was expecting closer to $70 billion. And because it missed Wall Street's estimates, the stock price came down. Now keep in mind that Alphabet still grew its revenue by about 6%, but still it did not meet Wall Street's expectations. Now, Alphabet is one of our favorite stocks, and we've talked about it before, but still Alphabet is down about 37% from its 52-week high. The next stock is Microsoft. Microsoft is a bellwether. It has been around forever. Now, Microsoft reported revenue of about $50 billion over the past 3 months. Now, this is up about 11% year over year, but still it did not meet Wall Street expectations. And because of that, the stock price came down. And Microsoft's stock price is down about 32% from its 52-week high. The last of our top 5 is Meta. Now, Meta by far had the worst quarterly report of all other companies that we're talking about. Meta had revenue of $27.7 billion, which is a negative growth year over year of about 4%. But Meta also had major issues when it came to how it was spending all of its revenue. You see, year over year, when you look at its net income after it's paid for all its expenses and all its research and R&D, it actually had a negative 52% growth in revenue year over year. Now, what's really interesting is that when you combine all of these companies to get the average growth for all 5, you find the growth was about 9.4% in revenue. Now, this actually sounds like a really wonderful thing to still have growth in this environment, but Wall Street doesn't see it this way. You see, this revenue growth is actually about 15% lower than what it was in previous years. So even though there was growth, the growth in revenue wasn't as high as it used to be. And that essentially summarizes what is going on in the tech sector. The tech sector is still growing its revenue. It's still profitable, but it's not growing its revenue at the same pace as it was in the past. Now, this brings us to really what is going on in the tech sector and why stocks in this sector in particular have been down by so much. You see, when we start to dig into these quarterly reports, we find some recurring themes that are challenging the profitability of these companies. The first challenge that all these companies talked about was slower spending from consumers and from other companies that use their products and services. You see, these technology companies are seeing less customers spending money at their companies. And you see that with companies like Google and like Facebook who sell advertisements to other businesses. They're seeing their advertisement revenue come down because those businesses are spending less. You are also seeing people buy less products at Amazon and at Apple. The next challenge that all of these companies talked about was inflation. Inflation means higher costs and higher expenses for a lot of these companies, which of course tear into their profitability. The next challenge that these companies talked about were higher interest rates. Of course, interest rates are higher because of inflation, but a lot of these companies rely on debt in order to fund some parts of their businesses. Because that debt has an interest rate, these companies are paying more to service their debt, which of course goes into their profitability. The next challenge that all these companies talked about is the war in Ukraine and the ripple effect of all of the things that are taking place because of that. Be it energy prices, be it political uncertainty, be it people just scared to do certain things. All of this has played a role in the profitability of these companies. The next challenge was currency exchange rates. You see, the US dollar is extremely strong right now relative to the euro, to the yen, and to the pound. And because these companies are international companies that sell their products and services around the world, currency exchange rates plays a role in how much of their products and services other countries can buy that are spending dollars. Now, these challenges are not just unique to tech companies, but because tech companies touch so many different parts of the economy and the world, these types of challenges can be exaggerated in the way tech companies do business. Now, one thing that was consistently expressed on all of these calls and within all of these reports was lower expectations for revenue growth over the next couple of quarters. And these expectations are directly related to the challenges that we talked about. But because all of these companies expressed lower expectations, lower outlooks on revenue, on growth, Wall Street and investors definitely brought the price of these stocks down because of that. You see, so much of investing has to do with the expectations of growth. And tech companies, they're all about future expectations, things that they plan on doing that are going to change the world, that are going to make so much money. And if tech companies are coming out and saying, well, we're not going to do as much in the future, you could see how Wall Street punishes them because of that. You see, a prime example of this is what is going on with Meta. Meta, or Facebook, is investing a lot of money in what they believe the future of the internet will look like. That this social media company will someday be a company that brings to you virtual reality that you live in, that you're a part of, that is a part of your everyday life. Well, there are lots of investors that aren't buying into this vision and are walking away from Meta. And you can see it in what is happening with the stock price. Investors aren't buying into that potential. But technology is being scrutinized right now because of the economic environment that we are in. Whenever we start to tighten up from an economic standpoint, whenever we start to be in this recessionary environment, companies that are talking about things that are too far out in the future tend to get penalized. So if these companies are spending too much on research and development, if they are going too far into debt, if they are growing the size of their company too big by hiring too many people, by expanding too fast, but yet the economic environment doesn't support that, these types of companies and their stocks will be penalized. And that is exactly what's happening with Meta. So with all that said, the question that a lot of you should be asking yourself right now is, if you are investing in the stock market and you are interested in investing in the technology sector, what should your strategy be? Because a lot of these companies look like they are on sale. I mean, some of them are down 70% from their 52-week high. In fact, I think Meta is that particular company. But on average, this overall sector is down significantly. Now, is this an opportunity, or is there more pain to come for this sector? Now, I can tell you what we are doing, but I am in no way saying that you should copy this same strategy. You see, Christine and I have always invested in all of these companies in one way or another, either by investing in a total stock market index fund, in a technology sector ETF, or by investing in these companies individually, we have always done some sort of investing in the technology sector. We think it is a very important sector if you want to experience growth in your portfolio. But with that said, we also recognize that it is also a sector that has a lot of volatility, and for most people, if they don't have the long-term perspective to stay the course, it is not a place that they should be. You see, at the end of the day, whenever you are picking investments, it's most important that you recognize your own risk tolerance. And so for us, we have a higher risk tolerance because we have a longer time horizon. So we feel comfortable investing in technology because of that. And so when we see opportunities like we see today in the stock market, we don't do anything different than what we've always done. We have an investment plan that calls for a certain allocation into ETFs, index funds, and individual stocks of these particular companies. And so we just follow that investment plan. We haven't changed anything in particular. What we've done is we've done the research ahead of time, and we go to these quarterly reports to check in on the assumptions that we made when we first invested in these companies to make sure that we still want to continue to invest in these companies. So my recommendation to you all is to develop an investment plan that takes into account your goals, your objectives, your risk tolerance, and your timeline so that you know at times like this how to approach investing in this particular sector. For some of you, maybe technology isn't your cup of tea because you can't handle the volatility. And maybe for others, this is exactly what you've been waiting for. You've been waiting for this opportunity where stocks are at lows and you're finding this to be an opportunity to buy investments on sale. Whatever the case may be, it's always up to the individual on how they want to build their investment plan. And so I hope this video has given you food for thought and has helped you on your journey towards financial independence and retiring early. And as usual, if you like it, please give it a thumbs up, subscribe to our channel, and join the journey.